I'm Karie Meltzer with Investing Answers, and I'm here with Sara, our Chief Investment Strategist.
Hey, Karie.
Sara's going to tell us about some pretty important things you need to know when you start investing, and that's the difference between stocks, bonds, and funds. So Sara, start with stocks. Most people hear about them all the time.
Right, stocks are really the first investment term people usually come across. And all a stock is a little ownership interest in a company. So if you have a company that you really want to own, you can go into the stock market, buy one share of stock, and you are an owner.
Okay, so is investing in stocks a little bit risky?
It is. Investing in stocks is risky for a couple different reasons. One of them is that the prices fluctuate from day to day, and they can fluctuate by a lot. So you could buy a stock today for $100 and buy tomorrow, for reasons that maybe you don't even understand, your stock could be worth $90.
Okay, and I love that analogy that you were telling me about before, which is that you can kind of compare stocks to high heels. And so, it's easy to remember shoes in investing.
Right,
and so
exactly.
When you're investing in shoes, high heels are a little bit riskier.
Right, but they're always the first pair that every girl wants, right? They want to go out and buy the first pair of really great stilettos that they see because they're really fun and they're really sexy and everybody wants to be able to walk around in their great heels. But stocks, like heels, are really difficult to master. And so if you don't have the time or the inclination to practice investing in stocks like you would practice walking in heels, you probably really shouldn't be investing in them.
Okay, so if a beginning investor wanted to start with something a little bit safer, bonds might be a good idea?
Sure, so bonds would be your flat shoe of the investing world. Everyone has a nice cute pair of flats that they wear all over the place. And bonds are a lot safer than stocks because instead of buying an ownership interest in a company, you're lending a company money and they're promising to pay you back, plus interest. And it's that promise that the company is making you that makes them a lot safer.
Okay, so I've been hearing a lot about funds, and we invest in different kinds of funds in our 401ks, and so I know that there are 3 different kinds. So if you could first kind of tell me just what a fund is and how it's different from a bond or a stock, and then we'll get into the different kinds.
Sure, and sticking with the shoe analogy, I would say that funds are the sneaker of your closet.
Okay.
Really, if you have one investment, it should be funds. And most of us are kind of forced into buying funds anyway, because if you have a 401k through work, you have to invest in a fund. And even if you don't, if you work at home or if you don't have a 401k, funds are really the place to start. And all a fund is a collection of stocks or a collection of bonds, all packaged into one, like one-stop shopping.
Okay, so tell me about index funds.
Sure, an index fund is the plain vanilla fund that probably everyone at some point in their life is going to own. And all it does is it tracks an index, like the S&P 500 or the Dow Jones Industrial Averages. So those are indexes that are quoted pretty widely in the financial media, and an index fund just tracks that. So of the 500 stocks in the S&P 500, an S&P 500 index fund would own all of those stocks.
Okay, what about mutual funds?
Mutual funds tend to be more actively managed. So you have a fund manager who's picking, buying, and selling stocks to try to outperform an index. So if you do great research and you find a great fund manager, you would do better than an index fund. But if something happens and your fund manager doesn't make the right choices, you can actually underperform an index fund.
So it's a little riskier.
It is a little bit riskier.
Okay, and what about ETFs? I've been hearing a lot about them in the news.
ETF stands for Exchange Traded Fund. And for practical purposes, all you really need to know is that an ETF is like a mutual fund, except it trades like a stock. And it also has slightly different tax implications. So if you happen to want to own an ETF outside of your retirement accounts, you'll want to talk to your accountant about it.
Okay, well, thank you so much, Sara. It sounds like you don't have to be scared of investing terminology. Sometimes you just have to break it down into simple terms.
Sure, you just get 1 or 2 under your belt and then you should be good to go.
Okay, well, thanks so much for joining us today. Again, I'm Karie Meltzer.
And I'm Sara Glakas.
And if you want to learn more about all the different financial terms, you can check out the Investing Answers Financial Glossary at InvestingAnswers.com.